What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. So let's picture that you've snagged up a sweet ass deal on a commercial real estate loan. The sun's shining, the birds are chirping, life is fucking good. But with every loan, like every lease, you're going to have to read and understand it entirely. I can't stress this enough. And in particular, I want to highlight prepayment penalties. Now, you're probably thinking, what the hell's the deal with prepayment penalties? Why the hell would I get penalized if I'm paying off my loan early? If I'm giving you money back, why am I getting charged more? Doesn't make sense, right? But here's the thing. It boils down to the bank's terms and what the banks are doing with that money. You see, lenders are also like savvy investors. They deal with a shit ton of money, so they have to figure out how to make money on that money. When they give out a loan, they're banking on raking in a tidy sum of interest over that loan's lifespan. So if you, as the investor, decide to close out on that loan ahead of that schedule, it fucks everything up for them. That means that they're going to be making less money on that loan. And nobody likes losing money or making less money. So that's why they implement prepayment penalties, so that you keep the life of the loan so that they can forecast what they're going to be making on that money that they lend out to you. So let's figure out how to calculate a prepayment penalty. You essentially take the remaining balance of your loan and you're going to multiply it by a predetermined percentage of what the bank gives you. And that will be your prepayment penalty. So let's break it down with an example. Let's say you got a mortgage on an office complex with a 10-year term. 5 years into the game, you are deciding to hit the eject button and you want to sell the property. So this is where the prepayment penalty comes into play. Let's say your loan agreement stipulates a prepayment penalty of 2%. And that's if you pay the loan off within the first 10 years. Now, if your remaining loan balance at the time of the sale is $2 million, you got to crunch those numbers. So $2 million, you're going to multiply that by the 2% prepayment penalty, and presto, you're looking at a prepayment penalty of $40,000. Oof, that sucks. And here's a value tip for you guys when you're dealing with banks. You want to try to negotiate the prepayment penalty. When it comes to the prepayment penalties, your knowledge is power. So remember, you're going to hold the reins in the negotiations. And if you don't like it, you can always back out. But you can aim for the stars. So in this case, I would try to aim for no prepayment penalty at all, or try to drop that prepayment penalty, or cut the term down in general to, from 10 years down to 5 years. But let's be real. Sometimes life throws us curveballs and we find ourselves staring down the barrel of a prepayment penalty. So sometimes you're pretty much just shit out of luck. However, there's still some hope on the horizon. Sometimes banks will allow you to refinance with them. So let's say you bank with a bank named Hella Money Bank, right? And you can still negotiate with Hella Money Bank that if within that 10-year time frame, if you refinance with them, that the prepayment penalty is waived. And if all else fails, don't sweat it. There's always the option of a declining prepayment penalty. Think of it like a countdown to freedom. So in this type of scenario, each year that passes, the penalty will decrease until finally it gets to zero. So here's an example. Let's imagine a 5-year fixed loan, and it has the declining prepayment penalty that we're talking about. In year one, it could be at a 5% penalty, But by year 5, it's a 1% penalty. So essentially, every year it drops 1%. So if you decide to make your exit after, say, 3 years, you're going to be facing a 2% penalty in the 4th year, which is a lot better than facing a 5% penalty, especially if you have a large loan on your project. And then you have what's called a lockout prepayment penalty. And these are pretty straightforward. They essentially stop the borrowers, you in this case, from paying off your loans early. Usually they only last, 1, 2, maybe 3 years or so. And if they have a longer lockout period for whatever reason, these are usually preferred by lenders who plan to sell their loans later in the secondary market because they typically make more money by selling loans with strict prepayment penalties. And in those scenarios, ideally, you'd want to negotiate for a shorter lockout period, like 1 year, to essentially give you the flexibility to sell without incurring any fees. Knowledge is your greatest asset in the wild world of real estate. Also remember that everything is negotiable. And a lot of times, banks will want to vie for your business, so sometimes they will bend a little bit more than you think. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.